The bet everyone mocked until it worked. At the time, it looked foolish, even arrogant, a position so out of step with consensus that critics didn't just doubt it, they laughed at it. This story matters now because markets don't reward courage alone. They reward conviction that survives isolation. The trades that change history are rarely celebrated at the beginning. They are ridiculed, ignored, or dismissed as mistakes until outcomes force a rewrite. To understand how one bet reshaped perception, we need to return to the moment it seemed most unreasonable. It began when the narrative felt settled. Data supported it. Experts reinforced it. The market had chosen its story, and nearly everyone was positioned accordingly. Deviating from that view didn't just feel risky, it felt unnecessary. But one investor saw a contradiction that wouldn't go away. The price made sense. The logic didn't. Too much confidence was packed into too little margin for error. Assumptions were stacked neatly on top of each other, each one depending on the last to remain true. The early reveal wasn't about forecasting collapse. It was about asymmetry. Downside was being dismissed as impossible. Upside was already priced in. That imbalance bothered him more than any bearish indicator ever could. So he placed a bet, not impulsively, not loudly, quietly, with structure and patience. He sized it to survive being wrong longer than others could afford to be right. That choice alone made him an outlier. The reaction was swift. Commentators questioned his credibility. Peers dismissed the move as stubborn contrarianism. Social proof leaned hard against him. Each passing week, without validation, made the bet look worse. But he wasn't betting on timing. He was betting on pressure. And pressure doesn't announce itself when it begins. It announces itself when endurance runs out. The bet everyone mocked wasn't wrong yet, but it was already uncomfortable. And discomfort, when shared unevenly, has a way of deciding outcomes long before prices do. As time passed, the discomfort deepened. The market moved against the bet slowly, deliberately, as if testing his resolve. Each rally strengthened the consensus. Each new high turned the mockery louder, more confident. The story seemed settled, and he seemed isolated. The reveal deepened when the data stopped supporting the price action. Small inconsistencies appeared. Forecasts required more assumptions. Margins tightened where expansion was promised. None of it was dramatic enough to change the narrative, but together it suggested strain beneath confidence. The early conflict emerged in side positioning. Crowding intensified. Leverage increased. The same trade appeared everywhere, packaged in different forms but driven by the same belief. Success bred imitation. Imitation bred fragility. He adjusted nothing. That was the hardest part. Not acting required more discipline than trading ever could. He reviewed the structure constantly. Downside remained defined. Liquidity was intact. Time was still on his side. The bet didn't need to be right immediately. It needed the market to exhaust its certainty. Meanwhile, the cost of being wrong grew for everyone else. As positioning concentrated, exits narrowed. Optionality shrank. What felt safe now required constant reinforcement. Confidence became work. The moment of confirmation didn't arrive as a collapse. It arrived as hesitation. A rally failed. Then another. Good news produced weak reactions. The narrative softened, just slightly, enough to introduce doubt without triggering reversal. That doubt mattered more than any price move. Because once consensus hesitates, pressure shifts direction. The bet everyone mocked hadn't paid yet, but the balance had changed. And when balance shifts in a crowded market, outcomes follow, not because someone was brave, but because endurance outlasted belief. The shift accelerated when the market finally demanded proof instead of belief. A critical moment arrived, subtle, technical, easy to miss. A routine update, a guidance adjustment, nothing catastrophic. But it failed to reinforce a story everyone depended on. The conflict intensified immediately. Positions built on certainty began to wobble. Stops tightened. Hedging demand surged. Liquidity thinned as participants realized exits were no longer theoretical. They were necessary. Selling didn't explode. It layered. Each wave fed the next. Not from fear, but from structure. Crowded positions unwind in sequence, not chaos. The first sellers were disciplined. The next were cautious. The last were forced. He watched as pressure finally flipped sides. The same voices that mocked the bet now searched for explanations. Analysts revised language. Confidence cracked. The narrative didn't reverse overnight. It fractured. And fractures are where markets break fastest. As prices moved sharply, disbelief turned into urgency. Funds scrambled to reduce exposure without becoming the exit liquidity for others. Correlation spiked. Assets that once diversified risk fell together. The cost of certainty became visible in execution. This was the moment the bet became undeniable, not because it was bold, but because it survived. It survived ridicule. It survived time. It survived being early. And when the market finally turned, it did so violently, not against a bet, but against a crowd that had depended on comfort. The trade didn't just work. It taught a lesson the market wouldn't forget, that being early is indistinguishable from being wrong, until endurance proves otherwise, and that the most dangerous trades aren't the ones that look risky. They're the ones that feel obvious. The bet everyone mocked was no longer funny. It was instructive, and the reckoning was not finished yet. The climax arrived when the market finally completed the reversal it had resisted for so long. What began as hesitation turned into acceleration. Prices moved sharply, not because new information appeared, but because belief finally collapsed under its own weight. Forced unwinds followed. Leverage that once amplified gains now magnified losses. Liquidity vanished precisely when it was most needed. Funds that had laughed at the bet now rushed to escape it. The exits narrowed. Execution became punishment. And in that moment, the bet stopped being controversial. It became obvious. The resolution unfolded quietly after the violence passed. Prices stabilized at levels no one had imagined months earlier. Commentators rewrote history, explaining why the outcome had been inevitable. The same certainty that once mocked the bet now claimed to understand it. But the real lesson wasn't about foresight. It was about structure. The bet worked because it was built to survive ridicule, because it respected time more than timing, because it assumed the crowd would be wrong longer than logic felt comfortable, and sized itself accordingly. Modern relevance is everywhere. Markets still reward consensus until they punish it, still confuse popularity with safety, still underestimate how quickly belief can flip when pressure shifts direction. The bet everyone mocked didn't succeed because it predicted the future. It succeeded because it understood people, and people don't change. They follow comfort until comfort breaks. So, what do you think? Are we mocking the next obvious bet right now? The bet